Okay, so in the last part, we discussed accounts receivable. So that was short-term 30-day deals. In this part, we're going to talk about notes receivable, which is a short-term loan that's extended to customers for larger amounts of money. So companies do not charge interest on accounts receivable that are not past due. When a company extends credit for a long time or when the credit extended is large, the cost and potential for disputes increase. So then we're talking about using a promissory note instead of an invoice. And here's a promissory note. So let's take a look at it. This promissory note is for the amount of $15,000. The date of the note is November 1st, year 3. Stanford Cummings is borrowing from Allen's tutoring services $15,000. That $15,000 is payable on October 31st, year 4, which is 1 year from the date of the note. And there's interest on this note at the rate of 6% a year. The collateral for this note, and for those of you who are not familiar with the word collateral, collateral is something, an asset that you put up to guarantee the note in the event that the payments don't get made. When you, for instance, borrow money from a bank, the bank uses the car as the collateral for your loan. So if you don't make your payments to the bank, they take the car. And there's the signature of Stanford Cummings. So this is a pretty basic promissory note. We got 15 grand. We got to pay 6% interest. And the whole thing is due on October 31st, year 4. Here's some definitions for you. The maker of the note is the borrower. The payee of the note is the company or the person who is lending the money, the creditor. The principal is the amount that's being borrowed. The interest is the additional amount that's paid to the payee in order to make it desirable to make the loan. I mean, if you're loaning your money out, you want to get some kind of a return. The interest is your return on the investment. Maturity date is when the note is due to be paid. And as I said, collateral or assets that are put up as security for the note. So ATS loaned $15,000 to Stanford Cummings on November 1st, year 3. So pretty easy. We set up an asset exchange, right? We've got a debit to a note receivable and a credit to cash. And you'll realize at this point that receivables get their name. The account gets its name from the type of receivable that's inside that account. This particular notes receivable is loans. We also had accounts receivable in the last discussion. That was for accounts with customers. Cummings will repay the principal, $15,000 plus interest of 6%, or $900 on October 31st. So we get a year, and everything gets paid together, the principal and the interest. Now, at the end of the year, we have to recognize that we've earned some interest on this money. The note started, the note started on October 31st. So November, December, we have 2 months of interest to recognize. 6% of $15,000 is $900, and then we take that annual amount, divide it by 12, and multiply times the 2 months. That gives us $150 in interest revenue that needs to be recognized in year 4. So we're going to debit interest receivable because we're not getting paid that interest, but we need to recognize we earned it. And we're going to debit interest revenue, or credit interest revenue, rather. Now, in event number 3, the loan has matured. ATS collected $15,900 cash on the maturity date. Right? It's $15,000 of principal, $900 of interest. Now, we have to recognize how much interest is left to recognize. So we're going to multiply 15,000 times 6% again. That gives us 900 bucks. And we recognized 2 months of interest before. So we're going to recognize 10 months of interest now. So we divide the 900 by 12, multiply by 10, and we get 750 bucks. So we debit interest receivable for 750 and credit interest revenue. We've now recognized the revenue in the period where we earned it, and we have a total of $900 of interest receivable. So the entire amount of interest on the 15,000 is now due. All right, so the total amount of interest is 900. So we're going to debit cash for 15,900. That's what we're getting paid. We're going to credit notes receivable for the 15 grand of the principal and credit interest receivable for 900 bucks. That's what we're due. And it's all done. Note down here, the $15,000 is an investing activity on the statement of cash flows, but the $900 of interest is an operating activity. Okay, financial statements reveal key differences between the timing of revenue recognition. So here's what we're looking at. Here's what we just did, right? We recognized interest revenue of 150 in year 3, 750 in year 4. The total was 900 bucks. We didn't get paid until year 4. Accrual accounting calls for recognizing revenue in the period in which it's earned. That goes back to recognition before realization. So here's a balance sheet representation. Accounts receivable, allowance for doubtful accounts, net realizable value, right? That's the difference between the total accounts receivable and the allowance account. Then we have interest receivable and notes receivable. This is at the end of year 3. So now we're going to take a look at credit cards. And credit cards are an interesting thing. Remember, for us, credit cards is we take the credit card out, we give it to the merchant, we go home with what we bought. And hopefully we pay for it at the end of the month when the bill comes in for the credit card. But we never see the other side of the credit card transaction. What happens to the merchant? Well, the merchant has to pay the credit card company for the convenience of your being able to use the card. And that charge can be anywhere from 3% to 8% of the sale. In this case, we're saying ATS accepts a credit card payment for $1,000 of services rendered. Assume the credit card company charges a 5% fee, so 5% of $1,000. ATS is giving up $50, 5% of the sale for credit card expense to pay the credit card processing company for the privilege of accepting credit cards. That's why, if you notice, over the years, especially over the last 3, 4 years, 5 years, we've started to see more and more companies, stores, gas stations, restaurants, charging if you use the card. They add an additional couple of percentages because they don't want to pay this anymore. They figure it's a convenience to the customer. All right, so now we're going to look at accounts receivable turnover ratio, a couple of ratios that are very, very important to a business. The turnover ratio large companies spend literally millions of dollars to buy the equipment, pay the staff necessary to operate the entire departments, and so forth. When a customer is permitted to delay payment, the creditor forgoes the opportunity. So remember, when you allow people to not pay for their services, eventually, and I had that problem with several companies, you still have to pay the vendors, right? You still have to pay your employees. So if you're not getting paid on time by your customers, you have to go borrow money to pay your bills until your customers pay you, which means that it reduces your profitability. Accounts receivable turnover ratio. So this tells us how many times in a year do you turn over your accounts receivable. We're taking net accounts receivable, an average, because we're going to take beginning and ending accounts receivable and get an average from the two, and divide that into the sales. The higher the turnover, that means the shorter it's taking to collect. So you're turning over your receivables faster. The more important number, and the number I lived by in my career, is the average number of days to collect. We take that accounts receivable turnover ratio, divide it into 365 days, and it tells us on average how fast can we collect. Because if your average collection is 45 days on an invoice and you have to pay your vendors in 30, there's a problem there, because there's 15 days that you have to cover before you get paid by your customers. And that's it for Chapter 7